Hi, folks. I'm John. This is Caitlin from our team here at Brooklyn FI, and we're really excited for our friends at Rippling as they're getting ready for a potential IPO. And our team, having been through tons of these over the years, put together a guide for how to prepare for an IPO, in particular for folks at Rippling and what they're going through. And so we're going to dive in here today and talk a little bit about what that looks like. And so one thing, Caitlin, you and I have never heard anybody say when they were going through an IPO is that was a relatively simple and stress-free process, right? Has anybody ever said
Never.
that to you?
I have never heard it. It's always something is going to be thrown at you at the last minute.
And you're not going to be sure what to expect, what's going to happen, and how to navigate it. And so part of our job is to help filter through the noise. And a good way to do that is by being prepared and knowing what you're in for ahead of time. And so what's that timeline normally look like for an IPO, Caitlin?
Yeah, the timeline, there's a lot of sit around and wait in the beginning. You're waiting forever for that news of that liquidity event. Finally, that IPO is announced and the S1 is filed. Then everything's happening. Everything's happening fast. Information is coming at you left and right before we have that public offering. And we're able to then, at some point after that public offering, able to actually activate the diversification plan. The best time to start planning for that IPO is all the way back when you're just waiting for that liquidity event to happen. But most people actually don't do it until that middle time period after the S1 is filed and when we actually have a date or an idea of when the IPO might occur.
Yeah, a lot of folks call us up. It's maybe 2 weeks before the IPO, 3 weeks ahead before the IPO. Hey, I need to start planning for this. And we're happy to help folks that are in that situation if they weren't sure, they weren't ready, that sort of thing. But the most optimal planning happens when we have 12 months to 2 years ahead of that potential liquidity event to take advantage of the fact that the price is probably a little bit lower, that we have mixes of equity compensation, and so that we can have that plan and be your partner as opposed to you scrambling to find somebody to guide you through this right before it starts. And it's going to be a cluster, right? Our job is to help make it as less of a cluster as it is, but it's still going to be a cluster when this stuff happens. And so when we think about how to prepare yourself for an IPO, there's a few things that come to mind. One of the things that we're very mindful of is there will be conflicting pieces of information. Your HR team might say this, the finance team might say that, the custodian where your shares are might have some other information. Your buddy who's friends with the CFO and the co-founder might have some different idea as to what's going to happen. And last minute changes and unexpected restrictions on trading are also very possible. You might have to get on the phone with the transfer agent, the brokerage firm. You might need to quickly open up accounts that you might not have been prepared to do. Technology might work, systems might be old. The equity plan could have been in crayon in somebody's drawer in a filing cabinet a few years ago. Now it's in Carta and it's on its way to ShareWorks, and you can get very frustrated. And so we want to help make that a little bit simpler. We want to help you understand what you need to hold on to make this a little bit better. And so, Caitlin, walk us through what are some other ways we can prepare for an IPO and the paperwork that comes with it.
Yeah. Step one, we need to know what's happening first. Get your statements and your documents ahead of time. We need to know what there is, what is vested, what is coming up to vest, and what is the tax? What is it? Is it an ISO? Is it a non-qualified option? Is it an RSU? Have a very clear, simple strategy for what you're going to do when that trading window opens. The stock price is going to move up. It's going to move down. And you want to have a plan going in. Mentally prepare yourself as well for a 50% tax rate. Anything less than that is a really nice surprise, but be prepared to pay 50% in taxes. And you're going to need cash potentially for the exercise window. When we have an exercise window open up, it might be short and you need to have cash ready to go and ready to transfer where it needs to go.
Absolutely. Absolutely. It's not just logging into your account on the day of and hitting a couple buttons. It's some preparation ahead of time, not only in terms of paperwork, but also like mentally preparing for a big tax bill and this big change in terms of how your equity is valued and what it looks like. And so there's also this thing called qualified small business stock. What's that all about, Caitlin? Sounds like a really big tax unlock.
It's an amazing tax unlock. So this is a piece of the tax code that allows people who invest in small businesses when they have 50 million or less of assets, under 50 million of assets, and they hold those shares for at least 5 years. There is the potential that if it meets a few other qualifications that you can write off $10 million of those capital gains. So that means we are not paying taxes on up to $10 million of capital gains if all of the qualifications are met. This is a huge unlock for people going through these liquidity events who are very early on employees or investors of these companies.
And this is really key when we have somebody who maybe was an early stage employee, either early exercise some options, exercise some options over the years, but that was 5, 6, 7 years ago now. The company hasn't gone public yet. And now we're going back, we're trying to find out, well, we held these for 5 years. The company was a lot smaller then. Maybe it was below the $50 million asset test. Is it the right type of company? And oftentimes we need to get a lawyer involved for these sorts of things. A tax lawyer to write an opinion letter because the company might not put it in writing. But this is something we want to be on the lookout for, especially if your company's grown pretty fast and you weren't above 50 million, 5 years ago, and you've different lots of shares. It's going to factor into our trading plan, right? Let's hold on to these shares for 3 more months until we hit that 5-year mark because they may be QSBS shares. And yeah, big unlock. There's very few pieces of the tax code that give you $10 million in tax-free capital gains. Yep. I'm pretty sure, Caitlin, right?
This might be one of my favorite pieces of the tax code.
Absolutely. Absolutely. Really incentivizes you to take that risk when you were investing in a much smaller company. Couple of things we want to watch out for and how to avoid them. And so we've got a few quick tips here as we're getting ready for a potential liquidity event. First, your shares will often go through some sort of transfer agent. They're going to move from maybe Carta or some internal system to computer share AST, and eventually land into brokerage firm like Shareworks, E-Trade, Fidelity, Schwab, one of those places. You'll probably get locked out of the account. You won't have credentials. It'll be something new. This is why we want to have those statements saved ahead of time, so you know exactly which shares you have before any split, before any other changes, and so that we can reconcile that with what lands at the brokerage firm on the other side. We've seen mistakes. We've seen mistakes in terms of share quantities. We've seen mistakes in terms of the types of shares, the timing, the cost basis information. All of those things can get very messy during these transitions. And so having those statements saved, I know it feels like an arcane thing to do, but downloading those PDFs and saving them is really important so that we can do data validation on the other side. Let's make sure you get all the shares you're supposed to have and make sure they're the right ones with the right details for when we start to sell them and have tax consequences. Another one that comes to mind, lockup restrictions. Caitlin, lockup restrictions, I think that's kind of, if you're like a kid on their birthday party enjoying the day and like the piece of cake gets taken away, I feel like that's what a lockup is when it comes to a liquidity event, because you're not going to be able to eat the entire cake day one typically.
No, most of the time it's a couple months later before you're able to really unlock the value of those shares.
Absolutely.
So you just sit and watch them.
Yeah, you have to sit and watch that, which you are not used to doing when it's a private company and the price gets updated once or twice a year, maybe once a quarter, sometimes monthly as you get closer to a liquidity event, but typically not every single day, every single second of every day changing. And so getting advice earlier can help you navigate this, because there are not only lockups that happen after the company goes public, there's typically a pre-IPO lockup because of that data that's moving around, because of those shares that maybe a month or a few weeks ahead of your direct listing, IPO, SPAC, whatever it might be, you're not allowed to trade in the shares. And so if you're going to wait until the week before to make your exercise, you might not be able to do it. And so that's why we want to ideally plan at least 12 months ahead of any liquidity event and start to get the planning rolling. Caitlin, what do we got here in terms of taxes?
Yeah, a lot of people come to us thinking that there is this magic that we can work with their tax return where we're just going to be able to lower their tax rate. And unfortunately, that's not the case. In 99% of cases, there's not something we can do aside from something like a QSBS situation.
QSBS, right?
To unlock that lower tax rate. In a perfect world, we're going to get long-term capital gains rate. And that's going to be still 24% at the federal level and 14% if you live in a state like New York or California. So we're still talking about a 38%-ish tax rate here when all is said and done.
Yeah.
So that's why we say let's plan for 50%, especially if you're thinking that this event is going to be a 500,000 plus event for you. Plan on 50%. If we can get it less, that's great, but it's not likely the case.
Absolutely. And I think where we get the most tax advantage outcomes are when we are able to exercise and take action sooner, right? 5 years sooner for QSBS, 1+ year sooner for long-term capital gains on potential incentive stock options, that sort of thing. But there are trade-offs that come with that too. And there's risk, right? Who's to say that IPO will happen at the exact time we expect it to? We've seen a lot of that over the last couple of years. More tax issues, Caitlin.
Yes.
Sometimes on the dock. Wait, you mean to tell me that 1099 isn't always right?
No, a lot of times the 1099 is not right. And that's why we say we need to make sure we have those documents together. We know when things were exercised, when things vested, so that when the 1099 comes, we can update that form when we file the tax return so that it actually provides the correct basis information. A lot of times you'll see when your 1099 comes and you have company equity, it may report the basis, aka what you've paid for the stock, as $0, but you've already paid tax on a portion of that depending on the type of equity that it is. And we need to make sure that's updated so we don't pay too much tax or double tax in this case on
And
those shares when they're sold.
$0 cost basis in general should be a very blinking red flag for anybody. And so, because the only time cost basis is close to zero is maybe if you're a founder, you have shares that were issued at par value or next to nothing, or you're one of the first employees, got one of the first option grants. But even then, maybe you're 10 cents, 15 cents a share. $0 cost basis typically means something's wrong. Doesn't mean that's going to be that much better tax wise when we get the right numbers in there, but it typically is a sign that there's something wrong in the records. And so we've been through a lot of IPOs. We've learned a lot of lessons from it. And first of all, one thing to keep in mind, we might not know the trading restrictions that are in place, the lockup, what that looks like until right before the IPO. It's going to be new guidance, new policies. Your company's going through a transformation of growing up from being a private company to being a public company. The other thing that surprises a lot of folks, the stock market opens 9:30 in the morning, Monday through Friday. And, that bell, oftentimes you get to ring the bell when you're going public. But the trading in your company's actual stock will likely not start where you can see it and track it on websites like CNBC, Yahoo Finance, whatever it might be, until around lunchtime. And that's because when you have an IPO, there are investment bankers, and it goes through something called price discovery. And so the market needs to kind of, slowly roll some shares out there, see what the price looks like before it becomes more liquid and starts trading. And so you'll be on the edge of your seat, you'll be hitting refresh, but there typically isn't movement in the price for a few hours, which is kind of weird. I feel like we live in this very instantaneous society, but it's a little bit different. And then while very much caveat is that past performance does not indicate future results, the first day of trading is often one of the better days we've seen historically. People get excited. People get pumped up on Reddit. There is finally an opportunity for the general public and people who couldn't otherwise invest in this company to buy stock. And that often pushes prices upward on the first day. If things go well, you've got a good banker, things are going well for your company's listing. That doesn't necessarily mean in the long term it'll be like that, or that'll be the best price in the long term either. But there is an opportunity oftentimes to sell some shares in the first day for employees. And if that's the case, we often want to take advantage of it, take some chips off the table. And so, Caitlin, we talked a lot about IPOs, direct listings, very similar. There's also this other way people can go public, which is a SPAC.
Yeah. So we've seen a few SPACs in the last few years, and just know it adds a little bit of complication here. It's going to take time for the shares to convert and be available for you to actually trade them. A lot more fake news gets put out there about these companies, and getting accurate information is going to be really difficult. A lot of times you're going to see a stock split with a SPAC, and these are complicated. They take time. You may have had one share, now it's maybe 10 shares, and that takes time for the companies to figure out how many shares you actually have and how many should be traded and what your basis in those shares is. So basically, be prepared to sit around and wait. You're going to have to hurry at one point, and then we're just going to wait until we're actually able to make moves with those shares.
Yeah, we saw a lot of SPACs a few years ago. It's really kind of become a little bit less popular in the last couple of years, but wanted to note that here because that is kind of the third way to go public besides an IPO and a direct listing, a SPAC. And so getting ready for day one, Caitlin, somebody's watching this webinar maybe right now. It's the night before the Rippling IPO because they didn't hire anybody and they need to know what they need to do tomorrow. What should they be thinking about?
What am I allowed to do tomorrow? What shares am I actually going to be allowed to trade? Are there any restrictions, lockups, restrictions on those shares or on the time period I'm able to make my decision? What is my trading plan? What am I actually going in and wanting to do? Am I exercising? Am I selling? Am I doing a combination of both? What are the logistics? Do I need to give someone cash? Where do I have to send the cash to exercise if I'm exercising? And then what if I'm selling? Where's the proceeds going from that sale? Do I have accounts open? Do I have the accounts linked so that the money can transfer kind of seamlessly and I can actually get my money out of those shares? Where have you lived the last few years as after those shares were granted? Have you moved states? Have you moved countries? That's going to complicate where we need to pay taxes to. Um, if we've lived out of the country or in multiple different states, they may be owed a portion of those sales, and you may want to get ready for sending a good portion of your proceeds to those states or countries so that you don't get penalized for late or under paying taxes. Um, what do I do with this cash now?
Yeah.
I have the cash. I've paid the taxes. What do I do? Where should it go? What should I be thinking of next?
Yeah. Yeah. And I think, if you are that person who did wait until right now, this hypothetical eve of a rippling IPO, you don't want to do the cash, put it in a high yield savings account, give us a call. And we'll help guide you through it, because oftentimes what we see is, hey, I sold off my options, I sold off some of my RSUs, they took the taxes out, and everything's probably fine. I can go ahead, I can just buy that new car I wanted, put this down payment on the house. Oftentimes, you might get $200,000, $300,000, $500,000, but Uncle Sam still probably has a cut of that coming, because the withholding on a lot of these is naturally light, typically at about 22% withholding, when most people with equity compensation are in a higher tax bracket than that. And we also have a situation where if you are selling incentive stock options or ISO shares, there might be no withholding at all. And so therefore, a big bite of that is going to be going to a tax bill come April. So I've got some tips. If you're a longer-term Rippling employee and you have a mix of incentive stock options, non-qualified options, and RSUs, typically double trigger RSUs that are going to vest at the liquidity event, there's a variety of things we need to be thinking about right now as we get ready for this event. First of all, having incentive stock options and non-qualified options really gives you some really fun planning opportunities ahead of an IPO. And so we typically want to set a budget for how many ISO shares we can exercise without paying AMT or only paying a little bit of AMT. If you're not familiar with AMT, it's the alternative minimum tax. It is a special tax that applies to certain types of income, incentive stock options being one of them. And so we need to not only budget for the exercise cost, but also for the tax bill on that exercise. That's really important. We need to be mindful of the fact that all this equity really interplays with each other. So what we do with our non-quals will impact our ISO strategy, because there's an interplay between alternative minimum tax and regular tax. And so exercising non-quals ahead of an IPO is often something that comes with a large regular tax bill, not something we often recommend. That's something I want to do soon after the company goes public, when you can sell the shares. And we need to also be mindful of, if you have a bunch of double trigger RSUs that have been granted over the last several years, they're going to vest on this day the company goes public. And that can create an opportunity to have more exercise of incentive stock options with less AMT. And so all these pieces move together. It's fairly complicated, but an equity plan cannot be looked at in a silo. Oh, this is just my RSU strategy. This is just my non-qual strategy. This is my ISO strategy. That's inefficient. We need all of these to talk to each other as part of your plan. We need to understand what the inventory looks like, what the strike price looks like, and how to optimize those. And then we need this equity plan to talk to your plan. What are your goals? What are we trying to achieve? This is a life-changing liquidity event that you are about to go through. And we need to understand how the goals, the hopes, the dreams that we have play into what we do with this resource. And so, Caitlin, if somebody's a little bit newer at Rippling, they have just maybe double trigger RSUs, not options, what do they need to think about?
Yeah, so double trigger RSUs are great for private companies, because there's two events that need to happen before they vest. And when they vest is when they become taxable. So when we can't sell an asset, we don't want it to be taxable to us. So with the double trigger, we have the normal time-based vesting schedule. The longer you remain at the company, the more of your shares that are going to vest. But then there's a second vesting event, which is that liquidity event, that IPO, or the company being acquired, where second event triggers and now they are vested and they are taxable to you. They are your shares to do with as you please, aside from the restrictions that may be in place as a current employee of the company. So many companies give you an opportunity at IPO to sell a percentage of these shares. And then the rest are going to be subject to that lockup period of 6 months. So you want to go in knowing how many shares you can sell and how many you are going to actually sell. The withholding on these can be very tricky. Kind of as John was just saying, they are going to withhold taxes, but they are likely only going to withhold 22% until your income is over $1 million, and then they will begin withholding 37%. Some companies have begun offering the ability to change your withholding either right at IPO or for your future vests, and that's something you want to talk to your accountant about, and that's something we would plan for with an IPO as well.
Absolutely, absolutely. And so just to walk through a quick hypothetical here, somebody works at Rippling, let's say they have $1.5 million in double trigger RSUs that are going to vest this year. The first 1 million would like to be withheld at 22%, above that at 37%. If they have some decent other earnings, that it's likely that full 1.5 million in RSUs might be taxed at 37%. That in and of itself, we're looking at $150,000 tax bill on even after that cash comes home from this. And so we're going to be really mindful of both the planning opportunities to how can we mitigate that tax bill, and then on the other hand, just be mindful that the cash that you take out of this is not all going to be yours. Most likely, some of it's going to belong to Uncle Sam. But thank you, Caitlin. It's a fun time for folks that are at Rippling. And so we've got a bunch of resources for pre-IPO companies, how to plan for it. And so we have some videos going into the details of all the different types of equity compensation, how it's taxed, how you plan for it on our website, brooklynfi.com/equityed. We have a podcast where we talk about liquidity events, financial planning, all these sorts of questions on a weekly basis. It's called the Liquidity Event. And if you have questions, if you're wondering, what do I do with this equity? How do I plan better for this, potentially life-changing liquidity event that's on the horizon here, that's getting closer, that we've been seeing articles about? Book a call with our team, brooklynfi.com/discovery. We're happy to chat with you. If we can't help, we'll point you in the right direction. We'll help find the right fit. But we help folks all the time through these sorts of changes and have had a front row seat. There are millions of different ways you can optimize your equity compensation. That is overwhelming. There's a lot of noise out there. Your company Slack channel is blowing up. The guy in the cubicle next to you has this idea. Help us. Let us help you filter out that noise and make a great decision. Thank you, Caitlin.
Thank you.